Okay, let's dive into this. Welcome to The Explainer. Today, we've got an exclusive, data-driven investment briefing on what is arguably the world's absolute most dominant critical tech company right now, Taiwan Semiconductor Manufacturing Company, or, as we all call it, TSMC. We're going to strip away the noise and look strictly at the numbers, their strategic roadmap, and the market catalysts defining the whole future of global computing. Because honestly, if you want to understand the architecture of the modern AI boom and exactly where the smart money is flowing, you have to understand TSMC. I mean, just take a look at this number. $1.23 trillion. That is TSMC's staggering market cap as of mid-2025. This asset demands our immediate attention for one simple reason. It is the foundational bedrock of the global AI rollout. I mean, over the past year alone, TSMC's stocks surged a massive 155%. We're not just talking about some minor tech rally here. This is a fundamental repricing of a company that manufactures nearly all of the world's most advanced AI accelerators. But the question every smart investor has to be asking right now is this massive run actually justified? So to figure that out, we're going to unpack this in 5 quick parts. 1, the undisputed foundry king. 2, winning the node race. 3, the AI growth engine. 4, global expansion and CapEx. And finally, 5, valuation and market risks. All right, let's jump straight into section 1, the undisputed foundry king. And this brilliantly illustrates exactly why they have that title. Look at the Q3 2024 global foundry market share. TSMC commands a staggering 64.9%. Their closest competitor, Samsung, is sitting way back at just 9.3%, with the rest of the market fragmenting the remaining 25%. Think about that for a second. Nearly 2/3 of all semiconductor chips made by independent foundries globally come from one single company. In an industry defined by cutthroat competition, a 65% market share isn't just a lead, it's practically a monopoly on the leading edge. So, you're probably wondering, why is the gap so wide? Well, it really comes down to manufacturing reliability and scaling success. TSMC is famous for its flawless execution and incredibly high yields, and that consistency has earned them the absolute trust of top-tier clients. We're talking Apple, NVIDIA, the heavy hitters. They literally refuse to take their most advanced designs anywhere else. Contrast that with the rivals, right? Samsung is a tech powerhouse, absolutely, but they've struggled significantly with defect rates and yield issues on their most advanced nodes. And then you have Intel. Once the historical leader, they faced such severe execution delays with their foundry services that they didn't even rank in the top 10 foundries by market share in Q3 2024. That's a huge shift. Moving right along to section 2, winning the node race. Let's move to the timeline and see how this builds over the years. TSMC just consistently beats competitors to market with smaller, more efficient nodes. Look at this. They hit 3-nanometer volume production way back in 2022. By late 2024, they were already initiating 2-nanometer risk production, and they're moving aggressively into 2-nanometer mass production this year in 2025. But they are definitely not stopping there. Their roadmap shows N2P and the cutting-edge A16 nodes hitting volume production in the second half of 2026, and then the A14 generation in 2028. It's this relentless clockwork-like cadence that leaves their competitors perpetually stuck playing catch-up. And to truly appreciate the sheer scale of this engineering, we have to look under the hood. These technical advantages are basically TSMC's economic moat. In their 3-nanometer process, they are packing an astonishing 197 million transistors into a single square millimeter. I mean, it's mind-blowing. That density is what drives the extreme performance modern computing demands. And for the 2-nanometer node, they're bringing in nanosheet gate-all-around transistors and backside power delivery, basically innovations that massively improve power efficiency. The market is validating this tech right out of the gate, too. Apple, NVIDIA, AMD, Google, they're already locking down supply to power their next-gen AI and consumer products. Which brings us right to section 3, the AI growth engine. The financial impact of AI on TSMC is just staggering. 34%. In 2024, TSMC's revenue jumped by nearly 34%, hitting roughly $88 billion. And this hypergrowth, it's a direct result of TSMC essentially monopolizing the manufacturing of those high-end AI accelerators everyone needs. Morningstar analysts actually pointed out that AI chips, which made up about 15% of TSMC's revenue in 2024, are projected to balloon to 50% of the company's total revenue by 2029. Data center customers are just pouring billions upon billions into this, seemingly regardless of the upfront costs or even tariffs, just to build out their AI arsenals. But, it's not a complete slam dunk. There are risks. highly efficient, much cheaper open-source AI models, like DeepSeek, for example, have recently entered the scene. And as one Morningstar analyst noted, these highly efficient models have exacerbated concerns about whether simply throwing more raw computation power at AI is actually the best or the only way to improve these models. It makes sense, right? If developers figure out how to make AI incredibly efficient with software, it could temporarily depress the extreme demand for massive, expensive hardware computation. And for sure, that's a potential headwind for TSMC's AI revenue growth trajectory. Okay, let's look at the cost of all this in Section 4, Global Expansion and CapEx. So geopolitical realities and looming tariff threats are forcing TSMC to fundamentally alter its global footprint. They're having to build out expensive supply chains far outside of Taiwan. Right now, they're reportedly set to build up to 12 fabrication plants, or fabs, in Arizona alone. And this massive build-out is pushing their capital expenditures to totally unprecedented levels. TSMC is projecting 2025 capex at a staggering $40 to $42 billion, and market estimates suggest it could even top $50 billion by 2027 or 2028. Because these investments are driven so heavily by geopolitics rather than pure commercial efficiency, building in the US is just way more expensive, Morningstar actually downgraded TSMC's capital allocation rating to standard. Now, what's really interesting about this slide is it highlights the hidden, localized risks of actually moving supply chains out of Taiwan. In Q3, the profit from the Arizona fab plunged 99%. And why? Well, it wasn't a chip design failure. It was actually due to unstable gas purity from a local US supplier that forced TSMC to temporarily halt production just to protect their precious yields. It's a really stark reminder that trying to replicate TSMC's historically flawless Taiwanese ecosystem in the middle of the Arizona desert, it comes with some incredibly steep learning curves and unexpected margin pressures. Finally, let's wrap this up with Section 5, Valuation and Market Risks. So the big question, is all of this growth and dominance already completely priced into the stock? Well, looking at this analyst data from Morningstar, despite the massive 155% run-up over the last year, their fair value estimate for the ADR sits at $306. Compare that to a last close of $237.56. This tells us that, at least according to some expert models, there is still a pretty significant buffer between the current market price and the intrinsic fair value of the business. Basically, they view the stock as undervalued, believing the long-term AI demand totally outweighs those short-term capital and geopolitical costs we just talked about. And TSMC's management? They seem to completely agree with that optimistic outlook. They recently announced a hefty 17% dividend increase, bringing the quarterly payout to approximately $1.11 per ADR. Now sure, the raw yield might seem a little small compared to traditional dividend stocks, but an aggressive 17% hike? That is a massive signal to the market. Companies simply do not raise dividends this aggressively unless the management team is highly, highly confident in the long-term sustainability of their cash flows. So let's put it all together. Here is the balance sheet of the stock's future. On the bull side, you've got undeniable multi-year AI demand that's expected to hit 50% of their revenue by 2029. You've got incredible pricing power that maintains gross margins near 60% and a resilient, expanding global supply chain. But on the bear side, we absolutely have to weigh the risk of highly efficient AI models limiting the need for raw compute, plus that significant margin drag from building those super expensive overseas fabs, and of course the constant macro threat of tariffs and geopolitically forced capital expenditures. So, the crucial point is this. As an investor, you're presented with a company holding a near monopoly on the most important technological hardware of our generation. But maintaining that monopoly requires tens of billions in ongoing capital and navigating incredibly complex global geopolitics. So, is TSMC's undisputed technological leadership and AI upside worth the premium of its risks? Well, that's the data. Those are the facts. Now it's up to you to weigh them and decide for yourself. Thanks for joining me on this explainer, and keep learning.